What are institutional investors? An institutional investor is a big organization that invests money on behalf of others. Instead of individuals buying shares with their own savings, these are professional institutions like pension funds, insurance companies, banks, or large investment firms managing billions, sometimes trillions, of pounds. They're called institutional because they represent an institution, not a single person. Some of the main types include pension funds, mutual funds, hedge funds, insurance companies, and university endowments. Why does it matter? Institutional investors are hugely important in the stock market because they control large sums of money and have the potential to move markets with their decisions. When a big pension fund decides to buy shares in a company, it can boost demand and help push the price up. When they sell, the opposite can happen. For everyday savers, the link is surprisingly close. If you have a workplace pension, for example, chances are your money is being invested by an institutional investor somewhere in the background. They're making decisions that will affect the growth of your retirement pot. They also play a wider role in the economy. By investing in businesses, property, and infrastructure, institutional investors provide liquidity, making it easier to buy and sell shares, and help companies raise money to expand and innovate. Here's a simple example. Imagine you and a few friends each save £100 to invest. That's £500 in total. On your own, your buying power is quite small. Now imagine a pension fund where millions of people have each saved £100. Suddenly, that's hundreds of millions of pounds being invested together. That fund becomes an institutional investor. Because of this size, they can negotiate better fees, get access to investment opportunities individuals can't, and have professional managers making decisions. Compare this to a retail investor, an ordinary individual using their own money. While you might buy 10 or 20 shares at a time, an institutional investor can trade millions of shares in seconds. That scale makes a huge difference. What else should you know? Institutional investors often have more influence than ordinary investors, not only because of their size, but also because they can vote as a bloc on shareholder decisions. This means they sometimes shape the direction of big companies. For example, if BlackRock or Vanguard, two of the world's largest asset managers, support a company's policy on climate change or corporate governance, that decision can ripple across entire industries. They also face strict regulations to ensure they act responsibly on behalf of the people whose money they manage. However, there are downsides too. Since they manage such huge amounts of money, their trades can dominate markets and make it harder for smaller investors to compete on the same footing. Some critics argue that their size gives them an unfair advantage. And importantly, they don't always get it right. If institutions make bad investment or allocation decisions, millions of savers can be affected. To sum it all up, institutional investors are the giants of the financial world. Big organizations like pension funds and insurance companies that invest huge sums on behalf of millions of people. They bring stability, liquidity, and expertise, but their size also means they hold enormous influence over markets and companies, for better or for worse. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.